Hey, everybody. Roman Polnar here coming to you live from Pillar 6 College Planning. Welcome. And today on this episode, we're going to talk about the new FAFSA and specifically how that's going to impact divorced families because there are a lot of changes that are coming down the pike here that will affect how much financial aid your family is going to be eligible for and ultimately how much financial aid your student is going to get to pay for college. And there are really big changes that are coming up specifically for divorced families. And unfortunately, they're not good changes. That's the bad news. The good news is that there are some things you can do about it if you are prepared and if you know about these changes. And that's exactly what I will be talking to you about today. So I'm going to start by going over some of the basics because you really need to help understand and set the stage of how the financial aid works in order to then understand how these changes are going to affect you. And then at the end, I'm going to give you some solutions that I hope you're going to be able to use and qualify yourselves for more financial aid because we all know that paying for college is hard and they've gotten to be so expensive and saving enough money has been, virtually impossible for a lot of families. So let's get into it, shall we? All right. So the new FAFSA is going to be coming online on October 1st of 2022. And as of this recording, it's about a year and a half or so. And this gives you some time. Now, it's going to go into effect for the 2023-2024 school year. What does that mean? So if you have a high school sophomore right now, then you will effectively be filling out the new FAFSA because your student is going to likely go to college in 2023. If you have a high school junior right now, well, then the first year of college, you're going to be using the current FAFSA. And then for the following 3 years, you're going to be using the new FAFSA. Anyways, etc. But you always fill out the FAFSA 1 year before your student starts college. So what are some of the basic changes? Well, there's a name change. Nothing earth-shattering here, but you need to know about it. And it's probably more hype than anything else. But the old term EFC is going away. EFC stands for your expected family contribution. And it's going to be replaced by the new term called SAI, or the Student Aid Index. Different name, same exact function. There's literally no change. So the purpose of these two acronyms or numbers is to determine your eligibility for financial aid. That's it. And so the way that they're going to determine your eligibility is changing significantly. Never mind the name. But first of all, let's talk about the things that are remaining the same, which is at the end of the day, it's going to be the government formula that determines your EFC or your SAI. And that happens when you complete the FAFSA. Now, the FAFSA, for those of you who don't know, is the main and probably most important financial aid form that you're going to need to complete in order to let the government and colleges know that you're going to be asking them for financial assistance. And FAFSA stands for the Free Application for Federal Student Aid. You'll never need to know that, but just know that it's called the FAFSA and it's really, really important. And you will need to complete it in your student's senior year of high school, preferably in the fall. Anyways, when you complete the FAFSA, you will report your income and your savings, and the government is going to calculate what they think you're going to be able to contribute towards college. And presently, that's called your expected family contribution. A year and a half from now, it's going to be called your SAI. But for everything that we've learned so far, it's the same thing. Same number, which is basically the number that the government thinks you can afford to pay out of your income and your savings towards college. And so what I want to share with you now is the financial aid formula. If you remember nothing else, I hope you'll remember this financial aid formula. It is the foundation of our entire financial aid system. And here it is. Cost of attendance minus your expected family contribution equals your need. The need is the amount of financial aid that you're going to be eligible for. That's your funding gap. Now, COA stands for cost of attendance of 1 year of college. It's the total cost: tuition, room and board, books, supplies, fees, everything. You take that total number, subtract from that how much the government thinks you can pay. That's your EFC. And the difference is your funding gap. That's how much money you need to bridge the gap. And so in theory, okay, your cost, your out-of-pocket cost, should be limited to your EFC or SAI when the rules change, right? But basically, you would be expecting the college and the government to come up with enough money to bridge that funding gap. But in reality, most parents and their kids' cost ends up being higher than their EFC for two reasons. Number one, many colleges simply don't give 100% of the money that you need. They just don't have it. Secondly, a lot of colleges will include loans as part of your financial aid package. Now, it might be considered financial aid to them, and by definition, it is. But it's not a financial aid for you as a family. It's actually worse. I mean, think of it. You borrow a loan, you're going to have to pay it back at some point. What makes it worse is you're going to have to pay it back with interest, or your kids are going to have to pay it back with interest. So you're really paying more for college than you would have if you just paid for it out of pocket. So loans are not, or should not be, financial aid, and they don't do you any good other than just putting a Band-Aid on a funding problem. So because most colleges will include loans as part of their financial aid packet, at the end of the day, a lot of families will end up paying more than what the government thinks they should be able to, for those two reasons. And that's why we always teach our parents and their kids to learn how to lower the amount that the government is going to expect them to pay, which in effect will increase the amount of financial aid that you will be eligible for. So that if we can increase that number, even if some of it gets covered in loans, we hope that it will still be enough to bridge the gap. We also tell our parents to look for colleges that have good financial aid policies, because you want to be able to get up to 100% of the money that you actually need, right? And you also want to look for colleges that have more free money to give you, like grants and scholarships, as opposed to loans. And you can do all of this research, and I have other training that that talks about how to look for those colleges. And by the way, if you have specific questions, or if you're not sure where to find that training, just comment below that you're looking for that training, and we'll send it to you. But for now, let's just stay on topic and talk about how these changes with the new FAFSA are going to affect the divorced families. So that's our next section. There are big, big changes coming up in a year and a half that will significantly hurt the divorced family's ability to qualify for financial aid, unless you know what to do about it and you can prepare. So let's talk about that. Now, the current FAFSA only requires that the custodial parent complete the financial aid form, the FAFSA. So what does that mean? Well, the custodial parent, in the eyes of the FAFSA, is the parent with whom the student spends more time than they do with the other parent. So technically, if you have 50-50 custody and your student spends one extra day with one of the two parents, then by that definition, that parent becomes the custodial parent and will have to complete the FAFSA by only reporting their own income and their own savings. It will not count the income and the savings of the other parent. So what this used to do, and technically still does for a year, it gives families an opportunity to have their students spend more time with the parent whose finances are more favorable for the FAFSA, meaning they have lower income and less savings. So they're going to have higher need and they will be eligible for more financial aid. Unfortunately, with the new FAFSA starting in 2022, that's going away. And instead, the FAFSA will now determine or require, I should say, the parent who provides more financial support to be the one completing the FAFSA and reporting their financial information. And the reason why this is negative is because generally the parent providing more financial support is the one with higher income and more savings. So just with that one change, they're effectively increasing that student's expected family contribution because of the parent's higher income and assets. There are some things you can do to fix this. Maybe not entirely, but at least if you know these three things that I'm about to share with you, you will at least be able to lower the amount of money that the government will expect you to pay. So, solution number one, if you're the parent providing most financial support, is to watch your income. Because oftentimes, I mean, we can't, let me just back up for a second. You shouldn't like quit your job or sell your business and say, I've got no income, so give my student financial aid, because that can cause a whole lot of other different issues and usually bigger ones too. So you can't really change your income in most cases, and most families need every dollar to like pay their living expenses. But a lot of other things end up going onto your tax return that you might be able to control better. For example, a lot of families end up selling some investments in order to actually pay for college. Could be regular investments. It could be a piece of real estate, whatever it is. If there's a gain, it's going to be reported on your tax return, and that's going to raise your income and it's going to raise your expected family contribution or your SAI. In other words, the government's going to expect you to pay more. So if you can avoid making certain sales in those critical college years, that might be to your advantage. Secondly, if you have stock options, be careful about when you exercise them. So if you have any control over when you exercise those stock options, well, perhaps consider delaying them if it fits with your overall financial picture, because that will also lower your EFC. Well, actually, it lowers your taxable income, and that will lower your EFC. And then this is a big one, because a lot of parents who don't have enough money saved to pay for college in like a dedicated college savings plan, like a 529, or if they don't have enough money in the bank, right? Oftentimes, because they're good parents and they want to do everything that they can to help their kids, even at their own detriment, they're going to go and they're going to sell some of their retirement savings in order to pay for college. And this is like a triple whammy. It's bad, bad, bad all around. I mean, for one, you're pulling money out of retirement that you're not ever going to have anymore. And there's financial aid for college. There's no financial aid for retirement. Okay, so that's number one. Number two, you're giving up all of those years of potential growth that you could have had. That's gone too. But the thing that a lot of families don't realize, that the third downside is that the moment you take money out of your retirement plan, it immediately shows up as income on your taxes. And so you're taking money out of your retirement plan to solve a college funding problem. And it actually creates an even bigger college funding problem, because now your income is significantly higher and so will your EFC. And it's an artificial high income, right? So don't do that. And you're going to pay taxes on it. So try not to take money out of retirement. Okay, solution number two, you got to watch your savings, and you got to position your savings in just the right way, because that can also lower your EFC, because some type of savings count more on the FAFSA towards your expected family contribution than others. Some of them don't count at all. So if you learn about these things, then it gives you enough time to be able to position your finances in such a way that the FAFSA is either not going to look at your savings at all, or at least some of the savings, because then it will be earmarked for retirement, for example, or it's going to be earmarked in your house if you are a homeowner. But if it's just sitting around in the regular investment or cash or even college savings, well, all that money will be considered to be available to pay for college, and the government is going to count it. So learn how to position your finances in a more financial aid friendly way. Again, if you don't know how to do this and you want to know how, just put comments in the or put your question in the comments below, and we'll send you that training. I'm sure I have it somewhere on the Facebook Live page, but if you don't want to have to go through pages and pages, just send me a note, and we'll send it to you. And then the last thing about savings is you want to learn how to lower the value that the FAFSA is going to assess. So it's one thing to just look at your like bank statement or investment statement, or like on Zillow to see what your property might be worth, which is what most people do. But the FAFSA actually doesn't want you to do that. It allows you to lower the value that they're going to assess as being available to pay for college. And there are a lot of rules around it. And it's like over 100 pages of rules. But let's be honest, who reads those except us? So if you want to know how to lower the assessed value, drop a note below. But if you already know, then please don't forget to lower the value that you're going to report on the FAFSA so that you effectively lower your EFC. And then the third and final solution is that you could have multiple support agreements. You want to talk to your attorney about that, and don't spend a ton of time and money on this, but definitely do some research around it, because multiple support agreements may allow you to pick and choose different years in which the two of you, as two divorced parents, provide the majority of the financial support for your students. So there may be an opportunity for you to pick the parent that has more favorable, more financial aid friendly financial situation to be the one providing the majority of the support to the student in those college years. And that's really going to help lower your EFC. So we just went over a fair amount of information. I hope it was helpful. And I try to boil these things down into smaller chunks because, there's like 168 pages of financial aid changes that were just added in the most recent coronavirus relief bill in December of 2020. And it's like talking about all of them just can get overwhelming. But unfortunately, the divorced families are ones that will be negatively affected by these changes. And I hope that these three ideas that I just shared with you will help you in at least getting more financial aid than you would have gotten otherwise, but just not as good of a change as it is for some other folks. For what it's worth, the other two big negative changes were for parents that have multiple kids in college at the same time. I've mentioned that in a prior training. And the reason for that is that you used to be able to just get one EFC, or one expected family contribution. So if you have two kids in college, you basically divide that number in half, and each student will only be responsible for coming up with half. And under the current rules, it basically doubles the amount that you're going to have to pay. So you don't get that discount anymore. And then the other group of folks that will be negatively affected are going to be the mid-income folks, because their expected family contribution will automatically, or their student aid index will automatically be counted at a higher rate. And we've got some training coming up for both of these situations to try to help you kind of use these changes. I can't say to your benefit, because unfortunately the government did not do you any favors, but at least try to mitigate the negative impacts of these changes so you can get more money out of the financial aid system and actually pay for college with free money, as opposed to having to borrow and then pay it back. And speaking of which, I have some training, absolutely free training on freemoneyfirst.com. So if you want to go there, I'll teach you a little bit more about how to go after the free money first. So go to www.freemoneyfirst.com, and I hope it's helpful. And look forward to talking to you again soon. If you've got questions, Put them in the comments below if you have comments, and if there are things that you want me to talk about in these mini training sessions, let me know. And please, if you find this helpful, let me know by hitting like, sharing it with other parents. And I hope this is helpful. We'll talk to you soon. Be well.